So hi everyone, I'm Brian Slaywin from the Ben Franklin Technology Partners and welcome to the Opportunity is Knocking webinar. On behalf of Ben Franklin, we're pleased to welcome our presenter today, Mr. Tim Wachter, lead attorney at the Knox Law Public Strategies. Tim is a national leader in the discussion, structure, and use of federal opportunity zones as an economic development and wealth creation tool. A speaker at the PETA 2018 conference held in Erie, Attorney Wachter regularly advises governmental, business, and nonprofit clients on highly complex legal, regulatory, and public policy-related matters. Today, Tim will be addressing opportunity zones and opportunity funds, a new community development program established by Congress in the Tax Cuts and Jobs Act of 2017 to encourage long-term investments in low-income urban and rural communities nationwide. Once again, welcome. And now please get ready for Opportunity is Knocking. Ladies and gentlemen, please welcome Tim Wachter.
Thank you very much, Brian. I'd like to thank you and the Ben Franklin Technology Partners of Central and Northern Pennsylvania for hosting this webinar and being an early believer and an early adopter of the importance and possibilities presented by opportunity zones. As Brian said, my name is Tim Wachter. I'm a shareholder at Knox McLaughlin Cornwall Senate, and a member of the Business and Tax and Government Services practice divisions here at the firm. And I am the lead at Knox Law Public Strategies, consulting arm of our firm, which was designed to assist in the development and implementation of matters of public policy. We're located here in Erie, Pennsylvania. I am going to split our screen here and go to the presentation, and we'll just get started. In 1 second here. Very good. Well, good morning. This is Opportunity is Knocking, a presentation on opportunity zones. You see a website there for the flagship opportunity zone. That is something that we're going to get into in a little bit and explain the importance of that website soon. So we're going to go through the initial stuff regarding opportunity zones first. We're going to go through it quite quickly so we can get into some of the more detailed issues that we would like to make sure that we address. This was first pitched by the Economic Innovation Group in 2015 through the publishment of a white paper, and it was adopted by Congress in the Tax Cuts and Jobs Act of 2017. We have bipartisan prime sponsors of the legislation in both the Senate and in the Congress. And really what we have found here is that the opportunity funds are designed to be an aggressive investment of patient capital in low-income communities. What exactly that statement means is going to be detailed more in a little bit. But essentially, it is a federal tax incentive program designed to reinvest otherwise unrealized capital gains into opportunity zones designated by governors in certain low-income census tracts. The governors had designated these census tracts, and they were later certified by the U.S. Treasury. They were to be low-income community census tracts. They could be contiguous to those tracts if they were non-low income. And governors were limited to selecting a total of 25% of the total eligible low-income census tracts, up to a maximum of 300 per state. Now, I'm not going to go to that link below in the interest of time, but if you go there, you'll be able to see a link to a national map of all of the opportunity zones selected in the United States. So what are the tax benefits of the capital gains investment? Why is this such a big deal? Well, first of all, you have an opportunity to defer the payment of tax on your capital gain. You can reduce the amount of tax that is ultimately going to be paid, and you have the opportunity to grow that money federal capital gains tax-free. In order to make this happen, an investor, an individual who had realized a capital gain, whether it be through the sale of stock, the sale of a building, maybe the sale of a business, they have the opportunity to roll that capital gain over into an opportunity fund within 180 days of the realization of the capital gain event. Once that occurs, you will receive the opportunity to defer the payment of tax on that original capital gains until December 31st, 2026. Now, this is not an 8-year deferral or any specific time period. It has a hard deadline of December 31st, 2026. The reason for that date is that is the date that the Tax Cuts and Jobs Act of 2017 expires and would need to be reauthorized. I would expect and hope that that date would be pushed out in any reauthorization of the act. Regarding the tax reduction, what happens is you're going to get a step up in basis. If you keep your money in the fund for 5 years, you'll get a 10% step up in basis. What does that mean? If you made $10,000 on the sale of stock and you rolled that over within the 180 days into an opportunity fund, or as you can see soon, you'll be able to self-select as a fund, and you keep that money in there for 5 years, you'll receive a 10% step up in basis, meaning that you'll only pay tax when you ultimately do pay the tax on the value of $9,000. If you keep the money in the fund for 7 years, then you ultimately pay tax on $8,500 because you would have received a 15% step up in basis. And of course, if you keep the money in the fund for 10 years, if there's 10 years worth of investments that had been made, the appreciation on the value of your investment, if that $10,000 grows to $20,000, the appreciation is then federal capital gains tax-free. As you can see, this truly is an amazing tool. You have 2 ways to roll over your capital gains. The first of which is to roll it into a qualified opportunity fund, which is a traditional securities offering, typically which will only accept investments by accredited investors. This is going to be your standard Regulation D securities package with your subscriptions and your offerings, and is a fund that would be managed traditionally by a professional fund manager. The other way to do that is to self-select. The IRS allows for you to raise your hand one day if you have capital gains and to say, hello, I'm going to be a fund today. It allows you to self-select as a fund, and all that will be required at that point is the filing of an additional tax return and a form with the IRS. Last I had seen, that form had not yet been created. What is it that you can invest in if you're a qualified opportunity fund? You may invest in qualified opportunity zone property, which is defined as including qualified opportunity zone stock, qualified opportunity zone partnership interests, or qualified opportunity zone business property. So essentially, you need to acquire an ownership interest in whichever business it is that you're going to be investing in, whether it be through equity or stock or through a partnership interest. Now, with respect to business property, that's tangible, personal property that is going to be located in the zone. That would be machinery and equipment. I'm still trying to figure out exactly how it is you could have a gain or an appreciation on the investment in that particular item. So we're going to spend more time speaking about the qualified opportunity zone stock and partnership interest purchases. We're still waiting for some of these terms to be further defined by the Treasury. As luck would have it, regs are anticipated to be out either later this week or early next week. And I was hoping that they were going to come out yesterday so that we could redo this presentation and explain to you exactly what the regulations are. However, that hasn't been done yet. When you do make those investments in qualified opportunity zone stock or partnership interest businesses, you need to ensure that substantially all of the business activities are occurring within the qualified opportunity zone. What substantially all specifically means, we don't know yet. We're waiting for the regulations to define that. But it is important to note that these businesses, whether it be a business that you invest in the stock or the limited partnership interest in, they do have to be located in a qualified opportunity zone. We would anticipate that with the release of the regulations here in the next few weeks, that deals should be commencing in the first quarter of 2019. Now, the investments are either to be an original use investment or a substantial improvement investment. What does that mean? An original use investment, just like it sounds like, it's an investment that is where you tear the packaging off. You have a shiny new product, you have a brand new business, you have a new building that's going into a greenfield or a brownfield, you have a new use for a facility. That's an original use investment. That's your standard investment. The other type of investment is a substantial improvement investment. That is one that would be made into an ongoing enterprise, a business that exists or somebody buying in to an already existing real estate development. Those investments are required to have an additional investment beyond the purchase of the limited partnership interest or the stock or equity purchase. That investment is to be at the same level of your purchase price plus. And what does that mean? If you go in and you buy, you take your $10,000 and you buy a limited partnership interest into an ongoing enterprise, a business that is located into an opportunity zone, within 30 months, you must invest more than that original $10,000. And that investment is to be designed to cause a substantial improvement in the business itself. How long do we have to do this? Well, as of right now, the law says that there's going to be a test applied 6 months after the establishment of the fund to determine whether 90% of the fund dollars have been spent. That's a relatively short runway and does provide some investors a little bit of heartburn as to whether the fund is going to be able to find enough deals to make those investments within 6 months. It is anticipated, however, that the regulations are going to lengthen that runway, and I'm hearing to sometime between 20 and 36 months. We'll wait to see if that happens. So what is it that you can invest in? What type of entities can you invest in? Well, really, it's going to be dependent upon the investor's goals as to whether you want to do a traditional venture investment, an industrial investment, equity investment, real estate, housing developments, public-private partnerships, community developments, or impact investing. But as I said, how you structure the deal is going to be dependent upon the investor's goals. So if you have an investor who's looking for a return that is a higher return, you may be looking at a venture investment. If you have an investor that's interested in receiving, making more of a community impact and is satisfied with the deferral of the payment of the tax and the reduction in the amount of tax that is paid and not necessarily looking for a 5x return at the end of the investment, there could be an opportunity for them to do a community development project or focus more on impact investing. As we've discussed here today, opportunity funds are designed to be an aggressive investment of patient capital. Let's review and qualify that statement. You have 180 days in which to invest those capital gains into a fund. That fund is then, as of right now, going to have 6 months in which to make an investment into an opportunity zone business. That investment is either to be original use in order to get something new started, or a substantial improvement investment, which is going to require that you match your purchase price of the equity or the limited partnership interest plus. You have to do more than the basis of that purchase price within 30 months in order to give that investment or that business a real kick in the arm or a shot in the arm so that they're going to be able to continue to grow and prosper in the zone. And then it's patient. You need to let that money sit for 5 years, for 7 years in order to receive the step up in basis and the reduction in the amount of tax that has to be paid, and then up to 10 years in order to receive the tax-free appreciation on that. Let's move into some strategies for developers. You need to first identify qualified projects. A qualified project has to be a business that is located within a zone where substantially all of the business is conducted within the zone. That needs to be one that is structured in such a way that you can have a limited partnership interest or obtain an equity interest through a stock purchase. Once again, we don't know what substantially all means. That isn't defined in the law, and we're waiting for the regulations to define that. Developers also need to identify their investors or the funds, whether they're going to be the individuals who self-select or a fund that's existing. Those developers need to do a little bit of matchmaking, where they match the project outcomes with the investor's goals. We've determined that investors are often driven by certain things. They're driven by profit, the opportunity for an X level return. They're driven by the opportunity for tax avoidance, possibly by the opportunity to make a community impact or focus on community development, or otherwise receive some level of notability. If you're able to match your investor with the project so that they can receive the proper level of investment goals, you'll be able to design your project with your investor in mind. So you need to identify your project and the realistic outcomes. You should look at those outcomes as to what it would mean 10 years out in order to allow for the investor to receive the ability to have an appreciation that is tax-free. To do that, you need to really assess your market and make a realistic return assumption. Is this a business that you could have a 10 or 20x return? And if so, then maybe you're looking for a venture investor. Is this a community center where the individual that's the investor isn't really looking for a return, as there isn't going to be much of an opportunity for a return? Then in that case, you're looking for an investor who's going to be driven by the tax deferral and the reduction in the amount of tax that they have to pay. And then you structure the deal in ongoing enterprises with a substantial improvement investment in mind. You need to remember that when you have that initial investment, you need to match that and do more down the road within 30 months. So how would you structure such a deal? Well, you take a look at the equity interest that you'll be purchasing or the limited partnership interest that you'll be purchasing and try to project into the future what that's going to be worth, and then make that substantial improvement investment in order to help kick it along, give it a shot in the arm so that it's able to get up to that future worth. And you also need to structure your deal with an exit goal that meets the investor's drivers, whether it be profit or impact or notability or community development. The question has been asked as to how can you structure an exit? Well, if you have a real estate development project and you have a fund that is willing to put money into it, you as the developer realize that you could get money at about 6% in order to fund your development. But if you get an opportunity fund to invest the dollars at, say, 4% or 3%, with no payments due until the 10-year goal is achieved, it'd be a balloon payment. It's not structured as a loan, but it's structured as an equity interest. And you structure the exit event after those 10 years such that you would have to pay that 3 or 4%. Then you as a developer are saving 2 to 3% on a traditional financing of the development project. And your fund is getting a guaranteed return. That may be one way in order to structure a deal with an exit goal in mind for a more traditional or conservative investor. Some strategies to keep in mind for funds themselves and investors. If you're a fund, you need to determine your investment goals. Are you going to be a venture fund? Are you going to be a real estate development fund? Are you going to be looking at making investments with structured or guaranteed returns, or are you willing to let the market drive that? Do you have investors that are content with the deferral and the reductions in tax, and therefore maybe your investments are going to be more community impact or community development driven? Or are you looking for structured returns on exit? You also need to make sure that as you identify your investors, that you're trying to figure out how it is you're going to structure your deals. Whether you're going to have a standard venture style exit, in which you're going to let the market take over and you hope to grow it at a 5 to 10x return or more. Of course, those deals have more risk. Or whether you want to have that structured return, which would require more of a conservative investor who's looking for that structured return rather than a higher value return, which comes with more risk. We discussed earlier that opportunity funds could be cheaper than bank financing and how to possibly structure a deal in which you could have that structured return. You also need to, as you're structuring the deal, remember that the substantial improvement investment is going to come if you're investing into an ongoing enterprise. And that needs to be taken into consideration in the cash flow analysis, not only for the fund, but for the business itself. And you need to be vigilant for reinvestment opportunities. Oftentimes, funds are asking questions saying, well, I want to have my investors to get the opportunity to have the 10 years in the fund so that they can have the appreciation on the investment be capital gains tax-free, but a venture deal is only going to go 3 years. Or we're looking at deals that only go 5 years. What's anticipated, actually, it's expected that the regulations are going to discuss opportunities and ways for funds to be able to reinvest dollars after an exit event prior to the 10-year opportunity being fully realized. How are we going to develop the zones? Well, this is something that we've really come to specialize here in Erie, and it's something that we're going to be able to explain how it is that we're going to approach that. If I get my computer to respond. So we indicated that opportunity zones are designed to be an aggressive investment of patient capital. And so when you're developing your zone and you're putting together the plan for the zones themselves, you need to keep that in mind, and you need to be aggressive in your economic development approach. You also, in order to allow for the investor to receive the maximum tax benefit, we must have shovel-ready and investor-ready projects now. If you think about it, in order to get the full level of the reduction in tax, the 15% step up in basis, you need to keep the money in the fund for 7 years. Yet the deferral is only till December 31st, 2026. That's only going to give us a few more months in order for investments to be made, in order to reach those 7 years until such point that you ultimately have to pay the tax. So we need to be ready to go with not only the investments, but the projects as quickly as possible. We, here at Knox Law Public Strategies, we've identified 5 steps to opportunity zone development. Stakeholder education, investor identification and education, project identification and preparation, fund development and identification, and ultimately project promotion. The first 3 items, the stakeholder and investor identification and education, as well as the project identification and preparation, are steps that can be taken before the funds are even in place to make sure that you're preparing your zone, you're preparing your stakeholders and your investors to make sure that you're going to be able to capitalize on this opportunity as quickly as possible. Here in Erie, what we've done is we call the meeting of the various stakeholders within the community, whether it be the city, the chamber, the Erie Downtown Development Corporation, the county, the Community Foundation, Ben Franklin, Erie Insurance, the Senator, Erie Downtown, Erie Events, the Port, Jefferson Education Society, Erie Innovation District, the Erie County Gaming Revenue Authority, Housing and Neighborhood Development Services, and Erie County Economic Redevelopment have all come together in support of the development project that we have in Erie relative to our opportunity zone. Getting these partners in place has been absolutely key, as when we've been able to move forward without any regulatory or political roadblocks. What we've done is we've come together and we've declared that the 8 opportunity zones located in the city of Erie are going to be known as Pennsylvania's flagship opportunity zone. The picture, of course, is of the flagship Niagara, which was built in Erie in 1813 and used in the War of 1812 for the purpose of kicking the British out of the Great Lakes. There's a picture of our zones. We're lucky enough in Erie that we don't necessarily have sawtooth zones. We have zones that are fairly contiguous and fairly well laid out that encompass not only our innovation district and our downtown and our port and our waterfront, which has phenomenal greenfield waterfront development opportunities, but it also encompasses our neighborhood districts that are in need of some additional community development, as well as our industrial parks on the waterfront and in the city heart. We've determined as a community that we're going to create the Pennsylvania Flagship Opportunity Zone Development Company. This is going to be under the umbrella of the Erie Regional Chamber and Growth Partnership, with a board comprised of its funders and with consultant level staffing. We want to make sure that there is no staff specifically employed by the flagship Opportunity Zone Development Company, as we don't think this could be a real long-term opportunity, but more of a 3 to 5 year opportunity for the zone. And we don't want to have to keep a nonprofit going merely for the purpose of generating or guaranteeing a job for someone. We're going to focus on high-level marketing of the zone itself and the promotion of the zone and the city's investment prospectus. This development company has already identified significant levels of funding that have been soft-circled, and we should be looking for a formal announcement regarding the launch and the operation of this in the near future. Erie's been very lucky that we already have community development partners in place to handle physical zone development issues. The Erie Downtown Partnership, the Erie Innovation District, the Erie Downtown Development Corporation, VelocityNet, UPMC, and Erie Insurance have invested millions of dollars in our downtown center city in order to ensure that Erie is ready and in a place to accept large levels of investment by opportunity funds and other investors as we're growing not only our real estate development sector, but our venture and industrial economies as well. The development company is going to focus on 3 things: the quantification of what's going on in the zone and what's available in the zone, the identification of funds and businesses to participate, as well as the promotion. We want to quantify our deal flow. We want to inventory our entrepreneurs, our businesses, our housing development, real estate development, etc., deals which are eligible for and interested in receiving opportunity fund investment. We're lucky enough that we have partners in the county, within the county data center, and within the City Department of Community and Economic Development, where this data is going to be relatively easy to identify, and we've already started some of that hard work. We also want to be able to quantify the availability of local capital. As many of you realize, you will not be able to have someone come in from outside and invest in you unless you have skin in the game yourself. When's the last time you've gone to the bank and asked them for a loan to buy a business, and when they ask how much you're investing, you say, none, it's going to be fully bank financed? That's not going to work. And it's not going to work in this world either, where we need to be able to quantify the availability of local capital as well as the investments that we've made in ourselves in order to entice other investors. We also need to identify what supportive investments are available. Within the city of Erie, we have $600 million of real estate development going on right now, anchored in 4 main projects. And these investments themselves are showing that we believe in our future, and so others should as well. The supportive investments that could be used in order to show this are not only the real estate development, but also can be investments that have been made in the transportation sectors and infrastructure to support other investments and other opportunities that may be available through the opportunity zones. The flagship Opportunity Zone Development Company is also going to identify projects, specifically eligible projects that are eligible for investment and development, and build a database so that when we are contacted, we're able to offer as a Opportunity Zone concierge and be able to connect potential investors with projects. The Opportunity Zone Development Company is going to operate like Switzerland. It's going to be agnostic with respect to funds and with respect to projects. Not being profit-driven, it's going to be driven specifically to ensure that investment is done in the zones in Erie. It's also going to identify the local investors. Through partnerships we have with the Ben Franklin Technology Partners of Central and Northern Pennsylvania, and through the Chamber, the community foundations, and others, we've already started to work to identify potential local investors who may have standby capital gains that could be ready to be tapped to be invested into specifically identified local funds. We're also going to work on identifying those funds, the local or regional funds that have been developed or will be developed in order to support these efforts. We're currently working on the development of 1 qualified opportunity fund, and I've got 2 or 3 others in the works that we are aware of that are going to be focusing on our particular market. Those are the local or regional funds that will have the first chance at the opportunity to invest in the projects that we have in place. And after that, we'll be able to identify the national funds that we'll be able to entice with showing them how much we've invested in ourselves, as well as the quality of the projects and the opportunity for return. We also want to be able to identify the opportunity for partner investment, whether it be through venture capital investors, equity investors, or through the utilization of state and or federal programs such as CRIZ or tax investment financing, the LRTA, which is a tax abatement program, or new markets tax credits. We really do have the opportunity to stack the availability of economic development assistance with the opportunity funds. The opportunity funds and the investments there do not prohibit the utilization of any other economic development program that is available, whether it be on a state, local, or federal basis. And that's an opportunity that needs to be exploited for the benefit of the zone. We're also going to work on promoting the zone. We're going to promote the zone to existing entrepreneurs and others that want to move their businesses into the zones, to show them we have a happening entrepreneurial industrial scene and that we want to be able to get them to move into the zone to increase the economic vitality of that zone itself. We also want to promote the zone to investors, showing that there is a healthy deal flow, that we have significantly capitalized companies that are located within the zone, operating within the tech space, as we do through the work of the Secure Area Accelerator, or that we have through our traditional industrial heritage, or the new economy that is developing within the opportunity zones. We also want to be able to prove to them what the realistic return on investment potential is, whether it be through a structured investment deal or whether it be through experiences related to prior venture investments. We also want to be able to show on the healthy deal flow side the great work that our partners at the Erie Downtown Development Corporation and other entities are doing in terms of the real estate market that's going on in Erie. We have phenomenal development opportunities, whether they be on the bayfront or in the downtown sector, and we can show the investments that we've already made in those and how those can be capitalized upon by new investors through the opportunity funds. We're going to promote the entrepreneurial scene, the deal flow availability, and the commitment of local capital. We'll be able to promote specific projects if they want to be, and if they're ready for local investment as well as national investment. And also, one of the most exciting aspects of this is we're going to be able to promote the city and the zone investment prospectus. It's a static document that's been created by the City of Erie in partnership with Erie Downtown Development Corporation and the data center at the county. And we're going to work on this to make the prospectus a dynamic prospectus and to enhance it through the work of the zone. We'll get into how we're going to do that in a few seconds. I know this sounds like it's a pitch for Erie, but reality, when we're explaining how to best develop your zone, we're trying to use this as a best practice so we can show you what we've done so it can be replicated in other communities. To continue with our promotion aspect, we're going to go to the funds, go on the road show, have conference speaking opportunities, and present the enhanced prospectus that has been prepared directly to the funds and the investors. As a community, you need to get above the noise that is being created by the investment opportunities in the tier 1 markets, in the larger communities, and show that there are investment opportunities that are specifically available in your market, and that the Opportunity Fund program was created to specifically address those markets that have been otherwise seeing the investment as the economy has rebounded. With respect to the prospectus itself, as you're developing a prospectus for your community or your zone, you really want to put your best foot forward, as this is going to be the first impression of your zone that many investors and or funds are going to see. You want to crystallize 3 things: who or what your zone is. You want to talk about the good, bad, and the ugly. There's not a problem with showing your warts. That is part of the value of the Opportunity Zone and Opportunity Fund projects and possibilities, that you want to be able to show that you're going to be able to drive a large economic or community impact. You want to be able to move the needle by the investments. You want to be able to show what investments you have made in your zone through your supportive investments and your local investments. And also what opportunities are in the zone, so that you can show that there's a decent projects that need to be, that could be invested in, and the opportunity for a realistic investment return. As you're putting that document together and you're crystallizing those 3 things, who or what your zone is, what investments you've made in your zone in order to show that you've made the local investment, you've got skin in the game. You're also then able to show what opportunities are available in the zone. You put those 3 things together and you will have the ability to give a good first impression of your zone itself. The other thing, I guess it's crystallized four things, is why a fund should invest in the zone itself. And that's going to deal with a large part of the promotion, to show that you're part of a movement, you're part of making things better, and that there is going to be a realistic investment return. The City of Erie has decided with the Erie Downtown Development Corporation in partnership with the County Data Center that they were going to generate their own prospectus through using the resources at the Accelerator for America. This prospectus itself was recently, a portion of it anyway, was recently released in a blog post by the mayor at the Accelerator for America's website, where just a little bit was released to the public, and I look for an announcement related to the rest of the prospectus in the near future. The City of Erie investment prospectus is showing the zone, showing what the main benefits are. This, of course, is our waterfront, which is directly in the zone itself. The taglines are to build opportunity, restore hope, and transform Erie. It's an inspirational message that has been put together to help us market the zone to the local, regional, and national investors, to organize our assets to have maximum economic and social impact, as well as to help Erie organize stakeholders around the unified vision of inclusive growth. This slide itself that's directly within the investment prospectus really crystallizes the mission of the Flagship Opportunity Zone Development Company, a private-public partnership which is put together for the specific purpose of promoting this and promoting the zone so that we don't lose out on the next best investment opportunity that's hit this country. We've taken the zone and developed a market mental map. This market mental map really puts together in the various sections of our zones what the districts are, whether they be the central business and Bayfront Development District, the adjacent commercial and residential development districts, the adjacent commercial and residential development districts east and west, the industrial development district on the east, and the industrial development district on the west, which both offer greenfield and brownfield development opportunities. By putting this market mental map together, you're really able to show in one slide where the investments may be made within your zone and what opportunities may be available to an investor. This is a blow-up of that regarding the market mental map itself. And you can see in our central business and development district, it goes straight through the heart of the city into the downtown, where you're focusing on the areas that are having millions of dollars investment by Erie Insurance, UPMC Hammett, the Velocity Net, the Erie Downtown Development Corporation, and others, as well as the tech sector that is being built and the burgeoning tech sector by the Innovation District and the work being done by Gannett University, Mercyhurst University, and others in downtown Erie as well. You can also see the adjacent commercial districts and such. And you get a sense and a feel for where we are at. One of the most striking portions of this district itself, and that the investment prospectus is going to focus on, are the development opportunities that are directly on the waterfront. So the zone strategy that has been put together is to reinforce the growth of the central business district and adjacent commercial and residential districts by leveraging the current investments from anchor institutions, philanthropic stakeholders, and public sector partners at both the state and local level. Previously, I mentioned that we've had about $600 million worth of investment within the zone so far. That's where those investments are coming from. And the second part then is to accelerate the rate of investment in the nascent and emerging entrepreneurial ecosystem centered around the Erie Innovation District, the Erie Technology Incubator, legacy manufacturing companies in the urban core and the adjacent urban industrial parks. And I'd add to that through the attraction of new businesses within the zone as well. So we developed the Flagship Opportunity Zone Development Company. This company is going to promote the zone. It's going to promote the city's investment prospectus. It's done the work already with the stakeholder identification and education. It's already started the work on the identification of the investors and the education of the investors. It's working on identifying the projects, and you'll see in the prospectus, much of that work has already been done. Next, we're going to launch our website, which right now currently looks like this. But the website's going to be launched to be able to make that prospectus and the activity in the zone a dynamic prospect, not just one that is static and a leave behind after an investment meeting. And we're going to take this information and promote it such that we can get above the noise regarding all the other investment opportunities in the country and be able to present the best of which our zone has to offer for the investments that are available. The end goals here of the zone and the development company: to be prepared to quickly take advantage of the opportunity funding opportunities, to identify and to capture local and regional investors and funds. We get them excited about the projects that are available in our own zone, to market the zones to the funds that are existing or that will exist on a national basis, because experience shows that in order that we have to quantify our deal flow and our local investment commitment in order to get national investors interested. You need to have skin in the game before you can expect other people to invest in yourselves. And the prospectus, the Flagship Opportunity Zone website, our efforts, and those of our community partners are going to prove the case for us. So today we've talked about many different ways in order to structure a deal, in order to provide strategies to funds, and how to develop your zone itself. To follow along what we're doing here in Erie, it's really happening over Twitter, whether it be through Knox Law Public Strategies, Ben Frank Bryan, who's been our host of this webinar this afternoon, Brett Weiler with the City of Erie, who's taken the lead on the development of the city prospectus, my brother Matt, who's at the Erie Downtown Development Corporation, is the Vice President of Finance and Development, and the EDDC is making millions of dollars of investments in the City of Erie and has partnered with the city on the development of the investment prospectus, and of course myself. Those are really the main ways in which to follow what's been going on in the Flagship Opportunity Zone, and we invite you to join in the conversation as we continue to learn how to best leverage our assets. And of course, there's my contact information if you have any questions. We do have the availability not just to assist in the development of zones, but also in deals as they're putting together. We'd like to hear from you in the future. With that said, we'd like to thank you for participating today in the webinar. I wanted to make sure that we left some time and get through all that information in about 45 minutes so that we could have an opportunity here to answer some of your questions.
And we have quite a few lined up, Tim, so thanks very much for the presentation. Why don't we start off with question number one. If an investor wants to focus on community impact with no need for a return, may they do so, and is the substantial improvement investment test required in such a case?
Yes. So if you're going to be doing a community impact, you need to make sure that you're making an investment in an entity that you can acquire a limited partnership interest or an equity interest. You can't really make that investment in a nonprofit because they're not selling stock. They're not offering limited partnership opportunities traditionally. You can do that and take advantage of the deferral of the tax until December 31st of 2026 and the reduction in the amount of tax that you'll be able to pay at the 5 and 7 year goal lines through the step up in basis that'll be made available. You don't have to make a return if your investor is okay with that. However, if it is an ongoing enterprise, then yes, the substantial improvement investment is absolutely required, and the law makes no differentiation as to whether it's a for-profit investment or not.
Our next question, will there be a matchmaking process or some sort of concierge service to help investors find and invest in qualified opportunity zone deals?
That's really something that the Flagship Opportunity Zone Development Company is going to be able to focus on for our particular investments. Whether it's occurring on a national basis, I don't believe it has yet, and that right now investors and potential investors are doing the same as everybody else and combing the internets and playing on the Twitter to try to figure out where the right place may be to invest their money.
You sort of addressed this, but just to be clear, can a nonprofit add limited partners or equity partners without jeopardizing their nonprofit status?
Really, that'll be a question for a nonprofit attorney to address with you. specifically not the focus of this webinar. Generally, I'm going to say it's not a standard practice.
I can imagine real estate and housing investments, but can you give any examples of what a community development project might look like? How
Sure.
might that be defined? Neighborhood amenities, security cameras, etc.
Sure, absolutely. So a community development project in this instance may best easily be understood as a neighborhood center, one that could be set up by a development company, where that development company would offer limited partnership interest or stock interest in the development company itself, and then it would go out and generate the community center. With respect to security cameras and other issues, if that's something that the neighborhood center wants to offer, it's something it could offer through its operations. However, if you have the right investor who's not looking to actually make a return, that may be one way in order to do it.
Next question, and they're coming in fast and furious. Can substantial improvement match funding come from returns within the opportunity fund, another opportunity fund, or anything else?
It needs to be an investment by the same investor. So it can't be a match funding by a separate opportunity fund. How that fund itself gets the money, whether it be a return on a previous investment or not, is not addressed in the law. And as of this time, and until the regulations tell us otherwise, it could be allowed. But it does have to be capital gains that are invested in the same fund that made the initial investment.
Does an opportunity zone designation benefit a community within an innovation district?
Absolutely. It adds an additional layer of opportunity for those companies that are located within the innovation district. They can play together. There's no prohibition that I'm aware of on the innovation districts. Well, there's no prohibition against them working together and partnering to achieve their investment goals.
What is a bank's role in this program? Historically, government programs require a bank partnership. Is it required in this project as well, or is this totally separate from bank financing? And a follow-up, would bank financing be coupled with a fund?
So this is entirely separate from banks. A bank's role in this, quite frankly, is taking a local community bank who has investment advisors and who has a strong community presence, having them possibly looking into the creation of a fund to give their clients an opportunity to invest in that fund and then go out and use that to partner in investments that they may otherwise make. However, any bank financing that they may do within a project would be separate from an opportunity fund investment, as that bank financing is not capital gains. Remember, the only monies that can go into a fund and be invested into these opportunity zones have to start as capital gains. If a bank has capital gains, they can start their own fund with their own capital gains, but they wouldn't be using traditional bank financing.
How can a community ensure high community impact projects that initially appear in the markets be low on return and then rise in the list so to receive interest from investors?
It's a really good question. I'm going to kind of turn the question around a little bit. You need to identify your investors. If you want to be able to get high on the list, you need to show that you have significant levels of local investment for those projects. Look, no return investments where you're making a community impact, you're probably not going to receive national investors unless they're niche investors, people who are specifically putting monies into funds that are developed solely for the purpose of making community impact. And those are probably going to be few and far between. So what you need to be looking at is specifically your local investors who are going to be able to make that happen for you, because they're either looking for the community impact or community development opportunity or the notability associated with making that investment. So if you want to rise to the top of the list, make sure you get your local investments secured first and show that you've got your own skin in the game.
And so to follow on to that, you've talked a lot about national funds. Is it realistic that a national fund would invest in projects in Erie?
Yes, I've spoken with funds already, people who are managing funds as recently as Friday.
Can the patient capital available via an Opportunity Zone fund be coupled with additional sources of patient capital, such as community foundations or banks' Community Reinvestment Act requirements to spur investment in traditionally low-income communities? In other words, can you blend capital from lots of resources?
Absolutely. There's no prohibition against various programs working together. You need to make sure that your Opportunity Zone funding, however, is separate in a separate investment in and of itself, so that the accounting is appropriate and that you know where the capital gains have been invested in order for them to receive the proper tax treatment. But there's no reason that there can't be a whole source or stacking of all the various capital opportunities that are available when going into a project.
So I've been told by my attorneys that creating an investment fund typically costs between $40,000 and $100,000 to set that up. Earlier, you said that for a single person to self-designate, it basically costs nothing. Can you explain the difference?
Well, what we're looking at right now are two different types of funds. The first of which is your traditional fund offering, which is a professionally managed securities-based fund that does have a fairly high cost to entry in order to make sure that you're not running afoul of the securities laws with the development of the necessary paperwork and the registrations on a state and local basis that are necessary. We're working on one right now where it's got it's on the lower end of the numbers that you just cited. But that's also a function of how much your attorneys are charging. With respect to rolling it over into an individual fund, according to the IRS's frequently asked questions, which up until the regulations are released is about the only authoritative document outside of the law, it comes forth and says that you can self-select and just say, hi, I want to be a fund today, and you get the paperwork and you file it. Now, whether you want to set that up as an LLC, that's not a high barrier to entry. You get an LLC done for, a very low figure.
So if I self-select as a fund, can I solicit my friends and family and others who have capital gains to invest in that fund?
No, because then what you're doing is you're requesting or you're soliciting other investments, at which point you're entering into that securities marketplace. So you can self-select and say, hi, I'm a fund today. But when you start asking other people to bring that money into the fund and you open it up for those investments, you need to start looking at the more traditional securities offering. So of course, I say this without the benefit of having any regulations. So We're just saying what it is and our understanding of the law is as it exists today.
Got it. What is the business attraction hook of this program? How might a company considering establishing a new operation within a qualified opportunity zone take advantage of this opportunity?
Move into the zone.
It's that easy.
I mean, so there's some disagreement amongst the tax lawyers. As a matter of fact, I have a bet. I got $5 pinned up on my wall over here and $5 pinned up over here with one of my tax partners, where we discuss what it means to be an original use investment. I believe that the law says that you can have an original use in the zone, where you can move a business into the zone. One of my tax partners believes that you can't have an ongoing venture, an ongoing enterprise outside of the zone and move in and still qualify for the original use investment. Those are things that we hope the regulations are going to clear up. But really, if you're an ongoing enterprise, you're a business, you want to take advantage of this opportunity to receive investment, you need to be operating in a zone, and substantially all of your operations need to be conducted in that zone. What substantially all means, we don't know yet. We're waiting for the regs. But once we have that, we'll be able to advise a little more clearly. But you have to be located in the zone.
So before we get to our last couple of questions, I'd like to thank you, Tim, for making this incredible base of knowledge available to everyone for free. As I mentioned, we are recording the webinar, and that will be emailed out to folks so that they can see this later at their leisure. And there will be other purposes for this recording as well. But Tim, thanks very much, and thanks for Knox Law Public Strategies for putting the effort and putting this together today.
Well, we appreciate your partnership, Brian. Thank you.
Last question. If you don't have a project ready to go in early 2019, it sounds like you won't be able to take full advantage of the program. Also, the program sunsets in 2026 and might be extended with legislation. In your opinion, what is the probability of that happening?
High. I think the probability of that occurring is high because we're going to see significant economic activity that is specifically tied to this program. We're anticipating, the Secretary of the Treasury said he's anticipating of the $6 trillion of unrealized capital gains that are in the United States economy right now, that about 100 billion of that is going to be invested through these programs. I would anticipate that that's going to be round one. And I think that it's going to continue to happen. And once we see what the true economic impact of this is going to be, the project itself, the legislation should be extended. This isn't to say if you don't have a project together now that you're not going to be able to participate in it. That's just to say if you don't have a project together now, your investor may not be able to, who's putting it into a fund, may not be able to get to the full reduction in the amount of tax that they have to pay. And funds may have to go out and find additional investors. But at the end of the day, I think you need to keep pushing with these projects, because even with having a 10% step up in basis and an ability to grow your investment tax-free is a significant advantage to an investor themselves. So don't worry too much about the fact that you don't have a project ready to go January 1st.
Once again, Tim, thanks so much for taking your time and sharing your this information with us. Easiest way to get a hold of you?
Shoot me an email at twachter, TWACHTER @kmgslaw.com, or give me a call at the office, 814-459-2800.
Great. Tim, thanks very much. Everyone who participated in today's webinar, thank you for your time and your attention and the great questions. And we'll see you sometime soon on another Opportunity is Knocking webinar. Thanks, everybody.
Thank you, Brian.